question in front of you. The requirement is calculate adjusted present value for the investment on the basis that it is financed by the subsidized loan, and conclude whether the project should be accepted or not. Show all relevant calculations. Discuss the issue which Tippletine company's shareholder who are not directors would consider if its director decided that the new investment should be financed by issue of convertible loan notes on the term suggested 5 months. Okay, so A and B part, here we are. Just take 3 minutes, read it well. Tippletine, please. Be quick. Read the requirements again and read the scenario once. Take 2 minutes only. Be quick. All right. So I'm opening Excel sheet along with it so that we can straight away start solving it. Tippletine is based in V. It is listed on V Stock Exchange, but only has a small number of shareholders. Its directors collectively own 45% of equity share capital. Tippletine Company's growth has been based on manufacture of household electrical goods. However, the directors have taken a strategic decision to diversify operation and to make a major investment in facilities for the manufacture of office equipment. Details of investment. The new investment is being appraised over a 4-year time horizon. Revenues from the new investments are uncertain, and Tippletine Company's finance directors have prepared what she regards as cautious forecast. These predicted operating cash flows are as follows: net operating cash flows before marketing, and then is the marketing cost, and then is the marketing cost, and then is the new investment will allow an immediate expenditure of 30.6 million. Tax allowable depreciation will be available at 25%, reducing balance basis. It can be assumed that there will either be a balancing power allowance or a charge in the final year of appraisal. The finance sector believes that facilities will remain viable after 4 years, and therefore the realizable value of 13.5 million can be assumed at the end of appraisals. Now, so this is the realizable value. The new facility will also require an immediate initial investment in working capital of 3 million. Working capital requirement will increase by rate of inflation for the next 3 years, and any working capital at the start of year 4 will be assumed to be released at the end of appraisal period. Tippletine Company pays tax at annual rate of 30%. Tax is payable with an year's time delay. Any tax losses on investment can be assumed to be carried forward and written off against future profits from the investment. Okay, so this is the year inflations. And Tippletine has been considering two choices of financing of all 30.6 million needed for as follows. A subsidized loan. With the loan repayable at the end of year 4, issue cost 4% gross finance would be payable interest at 30 basis point below the risk-free rate of 2.5%. In order to obtain the benefit of scheme, they would have to fulfill various conditions, including locating the facilities in a remote part of V, where unemployment is high. Convertible loan notes with the subscriber for the loan notes, including some of the Tippletine Company's directors. The loan notes would have issue cost of 4% of the gross finance. If not convertible, the loan notes would be redeemed in 6 years' time. Interest will be payable at 5%, which is Tippletine Company's normal cost of borrowing. Conversion would take place at an effective rate of $2.75 per share. However, the loan notes holders could enforce redemption at any time from the start of year 3 if Tippletine Company's share price fell below this. Okay, the Tippletine Company's share price is $2.2 per share. Issue cost, subsidized loan, would be paid out of cash reserves. They are not allowable as tax deductible expense. Now, next point. So the next point is, in initial discussion, the majority of the board favored using the subsidized loan. The appraisal will be prepared on the basis that this method of finance will be used. However, the chair argued strongly in the favor of convertible loan notes, as in his views, operating costs will be lower if Tippletine Company does not have to fulfill the conditions laid down by the government of V. Tippletine Company's finance acted skeptical. However, about whether the other shareholder would approve the issue of convertible loan notes on the terms of justice, the director will decide which method of finance to be used at the next board meeting. So, students, other information. H is a large manufacturer of office equipment in V. H company's geared cost of equity is this, and pre-tax cost of debt is this. These estimates are based on capital structure of comprising irredeemable bond trading at this and equity share trading at this. And annual rate of tax is 30%. H company pays. Now, this is huge information. Now, what will happen? Students normally we lose ourselves, our focus, and we get confused until unless we know the structure of the question. Remember, the information we need that should be in our mind for APV. The first of all is investment side. So Tippletine Company. So first of all, investment side. So what is the life of the project? The project life is 4 years. So 0, 1, yes, it will be like good like this. Now, 1, 2, 3, and 4. So net operating cash flows excluding marketing. Operating cash flows excluding marketing. That is 2,000, 14,500, 15,225, 15,834. Marketing cost 9,000, minus 2,000, and so on. Same. Students, these are the cash flows. Now, the point is, we need to calculate capital allowance, which has to be deducted from it. Which has to be deducted from it. They said that tax is payable without time delay. Tax losses on investment. It seems like there are losses. And when there are losses, we should try one thing. So first of all, here taxable cash flows. Let me tell you. When there are tax losses and which can be carried forward, always I suggest you do this working in the tax working in the workings of the question. Okay, so it will avoid undue complexity for you. I'm telling you. So in the working we will go. First of all, we need tax saving on capital allowance. 30.6 is the initial investment. So written down value 3,600, because we are using 3-digit round off from the start. All amounts are okay. So 3,600. So capital allowance, that is 25% reducing balance basis into 25%. Written down value, this minus this. So capital allowance, this into 25%. And once again, written down value. And once again, into 25%. What is the written down value? This minus this. Now, residual value is 13.5 million. Now, this is something unusual. Residual value is more. So, residual value, I will write here for your understanding. That is 13,500. And written down value is less. So, there will be balancing charge. This is more. This is balancing charge in the final year. Means this is profit. And you have to pay tax on it. On these three will be tax savings. On this, you have to pay tax. Now, so working of capital allowance is done. Now, tax payable, working. 2. It is capital allowance. Very good question. I'm loving it. You know, unusual questions are good. Now, so tax payable, we need to calculate. And how that will be calculated? Taxable cash flows are here. We will simply bring it here. Number of years are given above. Now, capital allowance will be put here. It will be deducted. Less capital allowance to make it taxable profit. Okay. Let me this minus this. Balancing charge. On this tax has to be, this is a different amount. Now, this is different amount. Yes. So, taxable profits. This plus this. Taxable profits. Now, focus everyone. Up till now, if there is any question, you can ask. If there is any question, you can ask before I proceed. So the next is, they say tax losses should be carried off. So losses carried forward. Losses carried forward. Now, you see here, it will be out of this 6752.5 here. Carried forward. It will be 0, taxable, and the remaining will come here, carried forward. Okay, thank you. 6762. Thank you. So it remaining will be carried forward here. So this is the now losses carried forward. So taxable amount will be there. So here it will be 0 because it is loss. Here it will be 0. This plus this. Here you go. So tax 30% rate, same year or arrears, 1 year in arrears. So for year 3, tax will be this into 0.3 and negative, it is payment. And so on for year 4. So that will be the tax we needed to calculate. This is what was required. So the tax payment year 5 equal to, here you go. Tax payment is done. So initial investment is initially this, and at the end it will be this amount, scrap value. And then is any working capital, here it is. So working capital increased by rate of inflation. And we released, so working capital adjustment we need to calculate. So 0, 1, 2, 3, and 4. At the start, working capital level, it is 3 million, 3,000, we call it. It is increased by rate of inflation. This is given. Inflation. This into 1.08. This into 1.05. Sorry, 1.06. Equal to this into 1.05. Equal to this into 1.04. Okay, let us make it positive amount initially. Level. Now we will calculate incremental working capital. So initial outflow. The next year, negative. This is needed. This is the level already. So the difference is the outflow. Just see here. This working. And we simply here. And in the now total outflow is this. This will be recovered. This amount will be recovered in the final year too. Recovered back at the end of year. Difference is outflow. And the final year, the last, it will be recovered as well. So net will be this. I repeat my words. This is the same difference between the 2 years. Outflow, and that whole will be inflow at the year. So just 1 minute, please. Now, so incremental working capital. So we will simply now, so net cash flows. Net cash flows. Okay, I will show you this one. This one. The difference of the both. This is needed. This was already there. The difference is the outflow. Is that clear? If there is any question, you can ask, please. Now, thank you. So incremental working capital is here in front of you. Now, come back to this. Net cash flows. These are the net cash flows. Now, what we need? We need discount rate. This is the project. It is currently manufacturer of electrical goods. Okay, they want to diversify and want to go for office equipment. And this is the company, office equipment, a proxy company. Its information is given, and we will be using yes, working for cost of equity of ungeared company. Working for, we need to calculate. So H company, details. Send your question to everyone. A good question. I appreciate. Send to everyone. I will explain it once I am done with this ungeared cost of equity. Okay. Let me calculate this and then I'll come back to your question. Now, so students, cost of equity, Mobile company, 10.5%. It is doing the same business. And its cost of debt pre-tax is 5.4%. Yes. Its market value of bonds, we need to calculate. 225 million bond, dollar. Each trading at divided by 100, trading at 107. This is the market value of bonds. Market value of equity. $125 million, $1 share. 125 million. What is the difference between this amount and this amount? Tell me. What is the difference? This is telling a nominal value, $225 million. This is telling a number of shares, not nominal value. Remember that, read carefully. You see examiner's tricks. This is a nominal value, it is dollars. This is 125 million shares. It is already number. Okay? Now, so 125 million into 3.2. Market value of equity. Now, we need cost of equity of an ungeared company. Okay? So, cost of equity of an ungeared company, the formula, my suggestion is always students should memorize formulas. Majority of the formulas. This is my suggestion. This is what I want. But the point is, this formula will be given to you in exam. But going and looking for the formula, it wastes a lot of time. And in the meantime, you can solve it easily, quickly. Now, so cost of equity of ungeared company. Remember the formula? We need to calculate. So let me show you one thing from the exam platform about it. I want to show to you people. Because recently they have given this formula with a change. They've just rearranged it. The formula is normally, we say that cost of equity of geared company is equal to cost of equity of ungeared company plus into 1 minus T, cost of debt into debt over equity into 1 minus tax rate. This is the formula which we have studied. But in the exam formula sheet, they have given it by rearranging it now. And that should be known to you if you are thinking to utilize that formula. Okay? They have given in the rearranged in both ways. Just come here. Let me show you. So you see here, it is shown in front of you now. This is what I wrote, cost of equity of geared company. This is the way I wrote. They have rearranged it. Same formula. We need cost of equity of ungeared company. They have just rearranged it. So don't be confused. Use this, the above one. Need not to go for the second confusion. So that's why I say you should memorize it. So cost of equity of geared company is given, 10.5% is given. Plus equal to cost of equity of ungeared company. We need Cost of equity of ungeared company, we need minus cost of debt 5.4% into debt over equity. Debt is 240.75 divided by 400 into 1 minus tax rate. 30% is it is 0.3. So we need to solve it simply by rearranging it. First of all, we will solve this factor. Just a minute, please. Let me solve it on the calculator. Okay, you can do this here. Yes. What you can do is simply, very easy. You see here, I put this factor here. Simply done. 0.421315. So I can say here working. Some working I'm doing here. Okay. So the examiner will see and will get to know what is this. So 10.5% equal to cost of equity of ungeared company plus cost of equity of ungeared company minus 5.4%. And what will be outside? 0.42. 0.42. So plus. Now this 0.42 will be multiplied inside. This 0.42 cost of equity of ungeared company minus a 0.42 into 5.4. This into 5.4. 2.28. 2.28%. Now 10.5 and this will come this side and it will be added. It will be 12.78% equal to cost of equity of ungeared company. Okay, you can see 1.42 cost of equity of ungeared company. 1.42. Simply mathematics. This will 1 and this will be added. So cost of equity of ungeared company 12.78% divided by 1.42, 9%. It is done. So cost of equity of ungeared company 9%. So present value at the rate of 9%. This into 1.09 raised to power minus this. Here you go. So this present value is calculated. Now we will add all that and we will get base case NPV. That is equal to sum negative 919. Base case NPV is negative. Now, the next point is, which is, yes. Now, financing side effect. The financing side, we need to go for that. Yes. So financing side effect. Let us proceed. What is the first thing? Without going to scenario, issuance cost. So we must know actually these things. So the first thing is issuance cost. So the first thing is issuance cost. So issuance cost is 4% of the gross amount loan. Yes, debt issuance, 30.6. 30.6. Okay, so 30.6 is the funding required, 3,600. 4% divided by 0.96. This is called grossing up. Into 4%. Simple is that. Grossing up and multiplied by now 4%. Okay, you don't want? Okay. Do it in 2 steps because this amount will be used later on in the calculation of tax saving on interest payments. This is the issuance cost and total loan. We can say total debt to be raised and issuance cost. This into 4%, 1,275. Issuance costs are not deducted, tax deductible expense. It is not tax deductible. Now, next point. What is the next working we need? We have to calculate tax relief. Present value of tax shield. You see here, total amount and the interest rate is just 1 second, please. 30 basis points. That is subsidy. Okay. The whole loan is subsidized loan. This is being yes. So students, what we will see, what is the cost of debt to the company? What is the cost of debt to the company? This is the normal cost of borrowing, 5%. 5% is the normal cost of borrowing. And they, due to subsidized loan, they are paying less amount. So we have to calculate working again. Working. So present value of tax shield. Basically, this is also working going on. Yes. This is also working. Yes. Working 1, working 2. Yes. Student, 3,600 is the loan amount. And they have to pay interest. How much? 2.5% minus 30 base, 0.3% less than that. 0.3% less than that. Now, over it, tax saving, 0.3 tax saving on interest payment. This is tax, this is interest payment. Interest payment into tax rate. Now, this interest have to be paid for 4 years. And tax is in arrears. Now, listen. We need to discount this tax shield. We have two options, risk-free at 2.5%. The other is company's cost of debt 5%. Now, I will prefer over here to make my calculation easy. 2.5% NOT factor is difficult to calculate. 5% easy. Okay. So companies, I will mention here, cost of debt, 5% will be used for discounting tax relief. Okay. Risk-free rate can also be used. Simple is that. Life is easy. So NOT, so this relief, annual relief it is. It will arise 4-year life. Starting from year 2 to year 5. Starting from, so delayed NOT. So delayed NOT, we need NOT table. We need NOT table. So I will bring that in front of you. NOT table. Yes. At 5% for 4 years. Because 4 cash flows are there. NOT table is here. Discount rate, yes. NOT table. 5% for 4 years. 3.546. 3.546. So into 3.546. It is simple, but it is delayed. 1 year discount rate at 5%, that is 0.952. This is delayed NOT factor. The other methods are also acceptable. If you have learned other methods of NOT, delayed NOT factor, that's also acceptable. So simple is that, and we will, okay, what is wrong? So this is the present value of tax shield on interest payment. Any confusion you can ask. I did it very slow, in very slow mode. Now the next is due to subsidy. What will happen? Present value of interest saved. Present value of interest saved due to subsidy. 3,600 into 5% is the cost. Okay. And how much they are paying? How much they are paying? We can say interest cost subsidized to 2.5% minus 0.3%. This is the cost. 2.2%. So they have 5% cost. They are paying 2.2%. So different is the saving. And the same annuity factor, which, no, not the same. It is simple annuity. This cost is being saved every year. So at 5% annuity factor for 4 years, 3.546. 3. This is the present value of interest saved. Now, present value of tax shield lost due to subsidy. Yes. So what will happen? 3,600 into 5% minus this. This is interest saving. This is tax saving lost every year from year 2 to year 5. For 4 years, delayed annuity. Into, now we need to write annuity factor here. Delayed annuity, 3.546 into 0.952. This is delayed annuity factor. This is tax saving lost every year. Yes. So tax relief lost every year. Any confusion if there is any? Now, so we have done all the calculations. So financing side effect. So let me move this working from here to here. Yes. Students, you might be thinking one thing. With debt, total funds needed basically. Total funds needed. Better words. But I have used this over here. Why? Can anyone respond to this question? Why I have not used 31875? Question, valid question. The question is, annuity factor is wrong. Are you sure? No, man. Annuity factor is not wrong. You just check yourself. I've done with extreme care. I appreciate you are involved. Just check it, please. Still, in the tax shield calculation, okay, I can see. Okay, yes, you are right. It is typo. It is typo. It is 3.546. Thank you. 3.546. Now, thank you. So tell me this answer. Why I have used this amount and not this one? Tell me, please. Anyone? Students, the reason is they said that issuance cost will be paid out of available cash reserve. It will need not to be raised through debt. It will not be raised through debt. Okay? That's why. That's why. So the next is financing side effect. We will calculate in full. Issuance cost. That is here. It is negative. Okay? Present value of tax shield on interest payment. It is positive cash flow. Yes. Present value of, sorry, this one. Present value of interest saved. Again, positive cash flow. Present value of tax relief lost due to subsidy. Negative. This. So, this is the total impact of financing side. Here you go. Now we need to calculate adjusted present value. So base case NPV plus financing side effect. 658. And 000, 658,000 actually, basically it is. So now the question is complete. Students, calculate, conclude whether the project should be accepted or not. So conclusion. Students, project has negative NPV. We know that. It is 919,000. So it is the financing side that is making it positive. Okay? It is the, and any other assumptions? Net operating cash flows. Okay, yes. So the adjusted present value of project is 658,000 positive. So it should be accepted on the basis of this financial result. But it is worth noting that its base case NPV is negative 918. If again forget, that is the 919 is negative 919,000. And it is only financing side effect which is turning it positive. Yes, turning it positive. And it is still on the basis of assumptions. All the forecast of cash inflows and outflows are all the forecasts of cash inflow are accurate. But being future estimation, these are subject to uncertainty. Uncertainty. So, a sensitivity analysis of key variables should be performed. And just a minute, let me, oh, there was another question. Sorry, forgot to answer that as well. I will answer both questions at the end. Just a minute, please. Should be performed, and a range of calculations of APV should be done under different possibilities. Possibilities and scenarios. And project should be, and then after proper assessment, a final decision should be made. Okay, the last question is, one question is from the student that should we write residual value? What you want to write? Tell me. What you want to write about that? It is too optimistic. What do you want to write? Tell me, please. Remember how, because you are saying it is high, that there is a balancing charge on it. Listen, please. Balancing charge is there for the reason that tax authorities allow that you can claim tax saving. You can claim tax saving as per allowed by tax authorities. That's why there is charge in the final residual value. In the books of accounting depreciation will be charged, of course, as per our estimation of residual value. There will not be any gain. If we estimate, there one is accounting depreciation, which we record in accounts. The other is one allowed by authorities. This is the capital allowance is what allowed by authorities. Sorry. So this debt, so that's why we cannot say it is high over here. If you think it is high, you should I think you are saying just because there is balancing charge. There is no reason for saying it. Am I right? Am I right? Tell me. Yes or no? It doesn't take this much time. Or something else. You can open your mic, talk to me if still there is confusion. This is some different topic now. Listen. Residual value is estimated. What I'm saying, focus that. Listen to me. I am saying that one is accounting depreciation. In books of accounts, depreciation will be charged based on this residual value. And there may not be gain on disposal of asset. This is just gain and tax payment because of what tax authorities ask us to do. They said you will claim capital allowance on 25% reducing balance basis. They say. In books of accounts, if we are charging capital allowance on 20% reducing balance basis, then there will be loss on disposal. Then capital allowance will be, you got it. Try to differentiate between the two. This is basic thing. That this charge is arising only because of one reason. That is the capital allowance dictated by tax authorities. So residual value is what, this phone with me. I know its residual value after 3 years. For example, it is $700 or $600. Initial price is $1,300. I will depreciate in my account the difference. $700 is residual value. Initial cost is $1,300. So $600 I will depreciate in my accounts. But tax authority says no. You have to depreciate it $200 every year for 4 years. So that what will happen at the year end, as per tax authorities, I have depreciated. So residual value will be more than the books value. So this is the point basically. Got it? This is basically, this gain is arising because of, if you are saying it is more, just only because of one reason, that there is balancing charge. So remember that this is not the logic, right logic, for saying it is more. Because charge is arising because of the tax authorities' dictation. They are dictating us. Okay. The second question was that another student, that what happened to capital allowance? A good question. Nothing happened. Normally, what we do is we deduct capital allowance here from these cash flows, pay tax, and then add back. This is what we do normally. That's correct. We have not added here capital allowance, not deducted. We went to a working, we deducted it there. Okay, we calculated tax. So simply, we need not to add back here because we did not deduct it. Simply tax is because that capital allowance is deducted and added back for the tax, to reduce tax payments, to incorporate tax saving. So we have done in a working now. So that's ignored afterwards. There is no use of that capital allowance later on. Okay, yes. Thank you. Thank you. So student, this part is done. So the other way, the convertible debt, that directors want to subscribe. Issuance cost is 4%, interest is 5% to be paid, and it will be converted into shares. So the requirement is discuss the issues which their shareholders will consider if directors decided that new investment will be financed by the issue of convertible loan notes on the terms suggested. Now, what are the convertible loan notes? We must know, first of all, before going to this requirement. Convertible loan notes are those loan notes which convert into shares of company, where the right of conversion is there. Okay? Right of conversion is attached. Normally, convertible bonds have lower they have lower interest rate than the normal loan note, normal debt of the company. Okay? So the point is, I will discuss in small points. Okay? I will discuss in small points over here. Yes. Convertible loan notes. Notes and views of shareholders. Because we have to talk about from the point of view of shareholders. You said what they will consider, or matters of consideration for shareholders. Remember, when the loan notes are convertible bonds are issued. It means, first of all, funds will be available immediately. I'm saying you have to write full sentences. And directors are going to buy, are also going to buy. So it is a commitment. It is the confidence in the operations of company, director's confidence. Shareholder will be happy. One thing. The second point is, on redemption or expiry, on maturity, they need not to be paid, need not to be repaid, as there is right of conversion. So company may not need to make available some funds to repay convertible debts. The shareholder will view the company will not have any issue because there is right of conversion. And directors are buying these bonds. They will get bonds converted into shares. So directors will work to increase share price of company. It will align individual goals of directors with that of company. One thing. Now, how many marks it beats? 5 marks. So 3 points we have discussed. Now, 1 or 2 drawbacks as well. One is it will increase gearing of company. Gearing and regular interest cost burden on the company. And shareholders' dividend may be affected because they will get only after interest is paid. Second point. The second point is, normally convertible debt normally have lower interest rates, but here terms are being suggested that includes cost equal to normal debt. So they carry lower interest rate because of conversion right attached. So it means this is being expensive for the company than the cost it should have. And thirdly, control of shareholders. Voting power. Because if they are converted into shares, so what will happen? Directors will get shares, more shares. And the voting power and percentage of current shareholder will reduce. It will affect the shareholders who are not directors. Okay, so this is done. So Tippletine Company, APV.